U.S. markets have seen multiple years of outperformance against their global peers, but with concerns around tariffs and the size of the American deficit, is that trend coming to an end? Joining us now to discuss, Justin Flowerday, Managing Director, Head of Public Equities at TD Asset Management. Always great to have you on the program.
Great to be here, Greg.
So we have seen this outperformance for a long time. Yeah. There was a lot of factors in place that fed that outperformance. Now there's questions. Tariffs, the big beautiful bill. What are we thinking about America right now?
Yeah, look, I mean, there's been no shortage of headlines and policy announcements which have, kept everyone on their toes. And you mentioned tariffs. I mean, there's been all the trade stuff has been absolutely nuts. U.S. dollar weakness has been a theme, and look, it has people a little bit nervous. And so, year to date, the U.S. is flat-ish as of this morning, and Europe is higher, and Asia is higher. So you have seen a little bit of underperformance by U.S. I mean, when thinking about what's driven outperformance for the U.S. over the last little while and whether that outperformance is over, which is the question that everyone's asking, I mean, you really do need to think about the driver, which is earnings growth. And over the last 3 years, over the last 30 years, U.S. earnings growth has been much more superior relative to the rest of the world. And it's because they have a massive innovation engine, right? And it's fueled by venture capital, and it's fueled by risk-taking. And it leads to innovation and the establishment of, world-leading technology companies and communication companies and healthcare companies that generate above-average margins, above-average returns on equity. I don't think that can be replicated overnight anywhere else in the world. So, the U.S. has had this moment where earnings growth has converged with the earnings growth in the rest of the world. Longer term, it still has many levers that'll allow it to grow earnings at a good clip.
Sounds to me like you're saying don't count the U.S. out just yet based on that strength.
That's my conclusion. Look, short term, anything can happen, and you're clearly getting some headlines and getting announcements that are causing people to reconsider their tactical asset allocation and allocation to the U.S. versus Europe versus Japan. Things can happen, and there can be short-term outperformance, but over the longer term, that's what I'd say.
So over that shorter and medium term, we have been looking at Europe, other parts of the world. What is the situation in Europe right now? Why is there this interest?
Yeah, so look, Europe has gone through this period of kind of resurgence and has played catch up, right? It's been an underperformer for quite some time. And it's played catch up because, earnings growth is looking better. In the short term, there's obviously lots of questions around trade and tariffs and what that can do to short-term earnings. But over the medium term, you've got defense spending, which is going to pick up, infrastructure spending, which is picking up. And so lots of kind of demand levers for the overall economy, which will lead to greater demand for companies in Europe and the products and services that they offer. The other thing I'd mention, though, is when you think about Europe, I mean, this is a group of 27 independent countries which have formed the EU. And as part of that, they have different worldviews, they have different priorities, and so there hasn't always been unity. And I think that lack of unity has led probably to lower productivity growth than they'd otherwise have. And now you're seeing unity, and you're seeing the leaders of these countries trying to get on the same page in terms of major issues that can help that economy going forward. So Europe's in a better place. I think, going forward, they're going to need to find things other than government spending to allow them to reinvigorate the corporate sector.
When you started mentioning about increased defense spending, increased infrastructure, try to boost productivity, made me think about the throne speech. It sounded like a lot of the things that Canada says it wants to do. Are we moving along that same thing as Europe? Do we have the potential in Canada to move along that theme?
Yeah, look, I think every country in the world and every company in the world right now is asking the same questions, which are, how can I do things better? How can I boost productivity in my economy, if you're a country, in your company, if you're a management team? And they're exploring everything. And so things that were off the table, politically, let's say, previously, are now back on the table. And it's a good thing because there's a lot of companies and countries who lack that urgency necessary to move the agenda forward and accelerate either GDP growth or earnings growth in the years ahead. So look, it's all from my standpoint very positive, and you're hearing it from companies out there today who are talking about, look, we're being challenged in this way, but it's made us look at this other area of our operation in a different lens, and we're implementing new technology. We're implementing different processes, ways of of thinking about our production, and it's all very positive, I think, for longer term earnings growth.
Right, so government's rethinking, the corporate sector is rethinking how to navigate these waters. As they start to make these pronouncements and start to put these plans in place, how do you see the second half of this year going? It's almost June. Before we know it, we will be in the second half of this year.
Yeah. So the second half is coming quite close, and if we think about some of the things we're looking at, I think I'll point to overall. Across sectors, trying to find companies that can maintain margins, right? That can come from having pricing power to be able to increase prices, and so that just comes from brand strength. The ability to adjust their cost base to protect margins, so that's a general theme. I would say, if you're looking at sectors, there's some sectors that are standing out, and some we've liked for a long time, others that we're starting to pay a little more attention to. I mean, I'll mention power generation as an example. This is something we've been quite attracted to for quite some time, and the trends there are only getting stronger. And we've got reshoring in the U.S. We have a lot of the AI theme that was called into question after DeepSeek in January is now kind of shown that this isn't gone, this is actually accelerating. I mean, when you think about the capital spending plans for the large technology companies going into this year, they were looking for about 20% year-on-year growth in capital spending in 2025. That was prior to DeepSeek. We just heard from them in the last quarter, and when you aggregate the capital spending plans on data center, they're now looking for 35% year-over-year growth. So it's actually accelerating, and as a part of that is just that power generation need, right? At the same time, you're hearing from Trump. We just heard recently on nuclear, and I think he put together kind of 3 executive orders to accelerate some movement there. Deregulation is moving forward. So power generation, the fundamentals in that sector are quite attractive, and I think that has legs. And it's not just months of legs, it's quarters and years.